Welcome back to this special conversation on Indianomics with the most powerful private sector banker, Chanda Kochhar. Let me now come to perhaps the most crucial challenge facing banks today, which is the problem of bad loans. I have some data from a brokerage which has calculated the amount of people who have not paid from 60 to 90 days. That is what we technically call SMA2. That was 2.8% of your loans in FY14. Now it has risen to 5.7%. So it's a substantial increase that people are not paying you till the 90th day. Therefore, do you think there is still one more quarter? Has this 5.7% come down at least?
So, since these are numbers from the brokerages, I won't really put our numbers vis-a-vis that. But I would say that clearly, there are sets of these assets that we continue to monitor. At the same time, we also believe that some of the cash flows would get realized either because of sale of assets that people have progressed with and so on. So I think fairly every bank is kind of monitoring the assets. Fairly we all know what direction each one of these companies, projects or groups are moving, and keeping all that into account only, we do feel that the additions this year should not be higher than the last year. If at all, they should be lower. So I think the only thing I can say is work is moving in the right direction. The problem is not over yet, but at the same time, it's not that it's just increasing and ballooning. I think.
Do you just have the satisfaction that the amount of money in SMA2 in quarter two versus quarter one is lower? Even then there is a...
See, I think again, one can't really say that for certainty every quarter, because actually what happens is that if one large company's, one installment is due and a cash flow is delayed by 2 months, you suddenly get that whole loan appearing in that SMA2. But once that installment gets paid, it moves out. So, in large corporate assets, sometimes one should not just look at quarter-to-quarter movements of just amounts.
Okay. But, the other confusion I have when I looked at the sea of data, there are a lot of companies which are already default grade with the rating agencies. GMR, GVK, Lanco, JP. JP went into default recently, but they're all standard assets with you. Why is there this discrepancy?
Also because that, in any public instrument or otherwise, even if there's one-day default, in terms of credit rating agencies, they do turn D. Whereas as far as banks are concerned, there is this little bit of curing period. On day one, you don't make them NPA.
Yeah, you have 90
Yes. So I think that's really one big difference.
Okay. To what extent have you been able to use the SDR or will be able to use the strategic debt restructuring? Do you think in the next quarter we will be able to see you spearhead and force a weak promoter to sell his asset to a strong promoter?
Absolutely. I think, this is a very good tool and we would be and we are using it, very effectively. First, actually, let me take a step back. That even if we may not call some of the actions as SDR, but we've clearly been working with promoters to sell their assets. And as I said, in many cases, it is not just non-core assets. It's core assets that have been sold. And they have been sold only because we have done almost something like an SDR, without calling it an SDR, but actually clearly brought about a change in management when those assets have been sold to another management. Similarly, even under the formal structure of SDR, we would be taking steps. We are already as we speak, going through some of them, and you will definitely see more and more action.
After all that, I would assume you're referring to the JP Group, where a lot of good assets got sold out. But even then, there is a substantial amount of loans that you, for instance, have about 10,000, 12,000 crores in various ways to the JP Group itself. Even after selling a lot, there is still a lot of exposure. So, lock, stock and barrel, will you look at, changing the ownership of assets?
Let me not talk about any specific group, but I think in any of these cases when sales take place, our exposures have come down, and they've clearly come down, partly because either the loan in that existing asset moves to the new management. Over and above that, whatever equity release that these groups get because of the sale, that also comes back to pay the loans of these groups. So clearly that has happened. But yes, I think SDR enables us to even bring about a lock, stock and barrel change of the ownership of the companies as well.
You know what, the brokerages, or some of them said that in many cases you had to actually lend more. Like for instance in Enron, in Ratnagiri you obviously are lending more because you're expecting the gas unit to become different, to become a different company. But you have had to lend more even for the Bhushans, the Lancos and such other companies. Is that true that in some cases you had to increase your exposure to some of them when you recast or refinance the loans?
So again, without ascribing anything to any particular case, but if there are projects under implementation and if for whatever reason those projects are delayed, and everything there is not just to do with financing, it's also to do with the environment. But if the projects are delayed, in any case the banks have to fund to meet the increase in the cost of the project because of the time. Similarly, if there is a debt restructuring and it is expected that the company from here on will revive and will start generating more revenues, participate in more tenders, participate in more contracts, whatever is the business of the company, and starts coming back to normal, that company would need that normal working capital to make its operations and revenues bigger. So I think to that extent, what the financing that would have been given is that legitimate financing to bring it back to growth.
On gas, for instance, gas-based power plant, everybody was caught unawares by the gas supply not being there. Now, the way Reliance has handled it, they want to dismantle their plant and take it to Bangladesh, Reliance Power, because they think this gas thing is not working for them. Are you confident, or is there hope for the others, the Lancos, the GMR Energies, to remain green, at least service debt with the arrangement put in by the government?
See, Lata, actually at ICICI, we had not funded any gas-based power project except for Dabhol, which we had for many, many years. But otherwise, because of this uncertainty of gas availability, gas pricing, in our basic project appraisal decision making, we had thought that this is a huge uncertainty. So we do not have any other gas-based power project in our portfolio.
Okay, so not your problem. I should be asking the others. Two very quick questions, because this is a group listing of the insurance wing. Do we see it in this fiscal or definitely the next fiscal?
Clearly we would do some monetizing on at least one of the insurance companies, whether it's listing, whether it's an additional investor or whatever. In that sense, we've not kind of fully made up our mind, but some monetization for sure.
This year itself.
I should say at least if March is an artificial cutoff, but yes, within 12 months for sure. Yes, if you talk of a year as 12 months for sure. Yes.
Okay. And the other thing I wanted to ask you, it's quite some time since you have acquired anything. What was it? Sangli Bank, Bank of Rajasthan.
Bank of Rajasthan. That was not big one. That was not very long ago. Yeah, it was a big one. Yes.
So should we hear something in a year, in 2 years?
I won't put any time frame again, but I would say we're always open. But at the same time, there's nothing cooking as of now.
No, certainly. But you see vulnerability for the mid-cap banks because of this competition. That would be a trend a year down the line.
Yes, it should be.
Okay. That will be also interesting times. Chanda Kochhar, pleasure speaking with you. Thank you so much for all the time.